What does your retirement look like? Are you confident you're on the right track? Navigating fluctuating markets alone can be confusing. Stocks, bonds, annuities, 401ks, and IRAs. Get ready to be informed and empowered by financial experts Joe Anderson and Alan Clopine. They'll simplify the process and give you the tools and strategies you need to map out the retirement you're dreaming of. Put their decades of experience to work for you. From Social Security to tax planning, they'll take the stress out of investing in your future. On Your Money, Your Wealth.
Stock market is at an all-time high, then it corrects, and then it reaches an all-time high again. That is normal. That is what the stock market does. It's called volatility. But what happens is when volatility is at its highest, that's when we tend to make mistakes. And if you're close to your retirement date and you're making those type of mistakes, it could absolutely blow you up. If you're worried about the state of the markets and volatility of the markets, this is the show for you. Welcome, everyone. Show's called Your Money, Your Wealth. My name's Joe Anderson, certified financial planner and president of, Pure Financial Advisors. And this show would not be a show without the big man. He's sitting right over there. There's Big Al Clopine. We'll be joining him momentarily. But when you look at volatility, folks, this is a normal stock market. We all remember this. This is 2008, right? The world is coming to an end. The market is collapsing. What are we going to do? But if you take a look at volatility since then, it's been relatively tame. We've had a really good market over the last 9 years. But if you're close to retirement, guess what? This potentially could happen again. Are you prepared for it? That's today's Financial Focus. We're talking volatility in the overall markets, and why on earth do we want to put up with it, right? Well, here's why. It's because stocks create a certain expected rate of return. It'd be great if we could put our money into treasury bills and live happily ever after. The problem is that a lot of us don't have enough capital to generate a 2% rate of return and live happily ever after. This is called a risk premium. If you take a look at stocks, the U.S. stock market over treasuries, they have outperformed by 8% per year. Since 1928 to 2015. This is called a risk premium. That is why we take the risk to get the return that we need to enjoy our overall retirement. Let's break this thing down a little bit further. Let's bring in the big man, Big Al Clopine.
Today, we're riding the wave of volatility, how to handle it. And this gets particularly important when you're in retirement or close to retirement. So first of all, let's talk about how to gain perspective. What you should know about volatility, what you should be concerned about, what not to be concerned about. That's number one. Then we want to talk about how to figure out the best portfolio for you, and it's different for everybody. We're going to get into how to invest. And then finally, there's certain things you can control and certain things that you cannot control. So focus on the things that you can control. So I think it's a timely topic because we are at all-time highs, particularly in the United States, and it's like people are a little concerned what's around the corner.
Sure. I mean, I think you got overconfidence too. It's like, hey, now investing is fairly easy. You know, I just throw a dart, I get in a mutual fund, and I'm up 10%. But it's not necessarily that easy because when volatility works both ways, people love volatility on the up, but when the volatility goes down, then that's where people get a little bit freaked out. So what we want to get into is looking at, all right, well, what should you do when volatility hits? And if you look at this screen here, this basically tells you why we even put up with volatility in the first place. Is that if we just kept our money in treasury bills, a growth of $1 doesn't really grow that much. But if we have large company stocks or small company stocks, value stocks, growth stocks, you know, all stocks are not created equal. And if we take on a little bit more risk with these particular issues, guess what? You're going to get a higher expected rate of return, but it doesn't work in a straight line. You're going to have some ups and downs and volatility along the way. You just have to learn to control your overall discipline or learn or understand exactly what your portfolio is doing. And I think, Al, that's a big mistake that people make. They don't get that perspective. They don't understand really what their goals are, what rate of return that they're looking for, or how that portfolio actually should be built.
Yeah, and I think the other thing, Joe, is in periods of time like this where we've had a good bull market, you know, a good bull run. So then it's like, what should we do? And the tendency is when the market is high like right now, maybe it's enough. Maybe we should get out. Maybe we should market time. And we know that when people market time, they don't necessarily pick the best times to get in and out. In fact, there's a Dalbar study that this is a couple of years ago. This is the last 20 years. I think it's from to 2016. The S&P 500 earned 8.2% during that period of time, and the average equity investor earned 4.7%. So about half of the market. Why? Because we have a tendency, Joe, to get in and out of the market at the wrong times.
Well, I mean, because it's the volatility, right? As volatility goes up, it's like, hey, we feel comfortable. Look at my statements. I'm making a lot of money. But when volatility goes down, we get scared, especially as we get close to retirement. It's like, oh, wait a minute. I need to use this money. This needs to create an income stream. This needs to replace my paycheck. But the problem is that we forget what our time frames are. Our time frame is not our retirement date. Our time frame is rest of life. And for a lot of you watching this program right now, it's 10, 20, 30, 40 years, right? So you need equities in that overall portfolio to make sure that you outpace inflation and that money's going to be there for you 10 or 20 years from now. The biggest mistakes that we all make is that once we see that decline, we bail. We get the heck out of the overall markets. That's why most average investors completely underperform the market by half. The market does 10, we do 4. I mean, it's crazy. We have to learn what we're doing with our overall portfolios before we can be successful as investors.
And it's really controlling your emotions, right? Because when we take a look at a typical market cycle, we tend to buy when we're optimistic and when we feel elation. And that's usually when the market's already done pretty well. It's gone up quite a bit. Then we tend to sell when we're nervous or when we're fearful. And at that point, so now we're buying high and selling low and repeating. And it's not a good recipe for success.
I mean, if you think about it, we want to buy things on sale. And so when the market is down, all right, that means prices are low. That is when we want to buy. We all know this. It is common sense. It's like, yes, of course, if I want to buy a new suit, a new tie, some new golf clubs, I want to buy them on sale. But everything we do in the market is the exact opposite because we are so emotion driven when it comes to our money. I don't want to lose any money because we're twice as fearful to lose $1 than we are happy to gain $1. So if you understand your biases, you understand your emotions, you understand your goals, you're going to be a better investor. And you know what's going to make you even a better investor? We have Brian Perry. He's going to come on board in our next segment. He's our director of research. He's a certified financial planner. He's a chartered financial analyst, and he's so much more than that. Just wait till you meet him. We got to take a short break, but we do have a special gift once again for our viewers. It's an investment guide. You can go to yourmoneyyourwealth.com, click on the special offer, and you can learn how to invest like the best. We'll be right back. We're just getting started. Show's called Your Money, and it's Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here with Big Al Clopine. We're talking market volatility today. We got a special guest, Brian Perry. He's a chartered financial analyst and a certified financial planner. He's also director of research at Pure Financial Advisor. Before we get to Brian, let's go see how you did on the true-false question.
Volatility is a measure of the frequency and severity of price movement in a given market. And Joe, that's a true statement.
It is.
That is what volatility is. And I think people get mixed up because they think volatility means that's when the market drops. No, it's the severity of the ups and downs. That's what volatility is. If the market goes straight down, that's not volatile. It just went straight down.
Well, it could be volatile because if it goes back up, then that's your definition again.
If it goes straight down and stays
down.
Thank you.
It's never going to happen. But that's what people think. That's what you think. It's going to go down. It's never going to come back up. It's going down forever. You know what we got to do? We got to get someone a lot smarter than you and I on this stage right now to talk about market volatility. So why don't you get the heck out of here, Al? Brian Perry's joining us. He's a director of research. He's a chartered financial analyst. He's a certified financial planner. He's got several, 10, 20 some plus years of market experience, and we're really excited to have him. So, Big Al, Brian, take it away.
Brian, thanks so much for joining us. So we're talking volatility today. So let's get right into what causes market volatility.
Well, a lot of things can cause market volatility, but two of the really common ones are geopolitical events like war, terrorism, elections. Markets don't like uncertainty.
And that's not about to change anytime.
It hasn't changed for the last however many millennia, so it's probably not going to change in the immediate future, no.
Right.
You know?
So, but given volatility, how should we invest?
Well, I think it's about accepting, first of all, that volatility is always going to be there, and then deciding, do you want to be a trader or an investor? And if you want to be a long-term investor, then you need to be in it for the long term. And a lot of people hate hearing that. They get sick of financial advisors saying, stay for the long term, stay for the long term. But I look back, it's October, so I look to 1962. October 1962, the Cuban Missile Crisis. Right? The uncertainty at that point was whether or not the Soviet Union and the USA would launch nuclear weapons at each other. Right? Was the world going to come to an end? And then we had Vietnam, we had impeachment for Nixon, we had stagflation, we had the 1987 market crash, we had the financial crisis. And yet, despite all that uncertainty, all that volatility that we've had, the Dow was at 600 back in 1962. Today, it's at like 26,000. So to me, the statistical record is that over time, markets head higher and investors do well, but they need to have that discipline to stay the course.
Staying the course, though, that's hard to do, though, sometimes, especially when it's your retirement nest egg.
It really is. I mean, it's by no means easy. And I think one of the things to do in order to help stay the course is make sure you have the proper portfolio to begin with. And of course, everybody's version of a proper portfolio is going to be different. But what you don't want to do is get overly excited by recent market events, right? We're in this great bull market where stocks have gone up for 10 years or whatever, for the most part, in a steady upward rise. And then it's, okay, great, let me buy more stocks. I want what's done the best. That's the worst thing to do. You need to keep your discipline and have a portfolio that's going to last you, not just during good times, but during bad times too.
So sometimes people think they can beat the market by getting in and out, or they can pick the best securities. And even money managers trying to pick the best securities, they don't always have the best track record.
That's true. And so let me ask you a question. You've got an IRA and a 401k, and I'm hoping based on a lot of what you say, you have a Roth. Would you take that Roth to Las Vegas and put it on the roulette wheel or the blackjack table?
Not likely.
No, not likely, and I'm glad to hear you say that, or I'd be really worried, right? So your odds of winning, depending on the casino, at blackjack are something like 48%, roulette's like 45%, and slot machines are like 35%. So people don't invest in that because you expect to not succeed. Well, if you look at the average active stock picker, they haven't succeeded. In fact, less than 1 in 5 historically have done their job of outperforming the index. That doesn't mean it's impossible, but it means it's really, really difficult to do.
When it comes to stocks, there's different kinds of stocks. They have different characteristics. So can you address, like, certain stocks tend to have higher performance than others?
Yeah, and so I think instead of trying to buy the best stocks, which involves looking to try and see the future, right? Instead, what you can do is try to buy the best kinds of stocks. So instead of individual stocks, the best types. And those characteristics are things that a lot of people call factors, which academics have found. And these are people far smarter than me. Some of them have won Nobel Prizes. And they went out and they did a lot of research and they analyzed all of the stocks that have ever traded, both in the US and in all these other countries, the UK, Australia, and so on. And what they found is that certain kinds of companies do better, certain kinds of stocks do better. And in particular, value companies, value stocks tend to do better than growth stocks. Small companies tend to do better than large stocks. And then finally, more profitable companies do better than less profitable companies. And so the idea is that in building a portfolio, you overweight those securities that historically have done better. And of course, that's no guarantee. Right? It doesn't mean that this is going to do better all the time. Recently, over the last couple of years, growth stocks have done better than value stocks. Small companies have done pretty well, but the value part that historically has been so great has not performed that well. But if you look over the long-term track record, these companies expect to do a little bit better. And by having securities in your portfolio with higher expected returns, what you can do is you can own less stocks. And the reason you want to own less stocks is that allows you to own more safe assets. And that's really investment nirvana, right? Because you can build a portfolio that has the same expected return or a similar expected return, but with a smoother ride. And I think for a lot of people, particularly as they enter into retirement, it's about, hey, I need whatever percentage return on my portfolio based on my financial plan. Then let me get it with the smoothest ride possible so that I can go enjoy my retirement.
So what you're saying is you can be a little bit more aggressive on some of your stock portfolio, which allows you to have actually less invested in the stock market to try to smooth out the ride.
Exactly, and then you fill in the rest with safe assets, maybe a little bit of cash, maybe some high quality bonds, and you remember that you're taking your aggressive position, your growth in your stocks, so you keep your bonds safe. You buy high quality bonds, you buy relatively short maturity bonds because they're less susceptible to interest rate increases, and by pairing those high quality bonds with somewhat more aggressive stocks, you build a portfolio with attractive expected returns, but your ride is smoother than if you just piled all of your money into, let's say, the S&P 500.
So let's talk about investors that get nervous about we're at all-time highs and they want to get out of the market. What tends to be their experience?
Well, that depends heavily, right? I mean, if they've got a really good crystal ball, their experience is really good. Right? Absent the crystal ball, it tends to be abysmal. And really, they have a couple of challenges. And the first of those is that, like I mentioned, over time, the upward momentum of the market is higher. And so you're swimming across a rising tide. The second part of it is that it's really hard once you get out to know when to get back in. Right? If you think about it, in September of 2008 was a great time to get out of the market when Lehman Brothers went under, but the market bottomed in March of 2009, and how many people had both the foresight and the intestinal fortitude to get back in then? And then the third problem is that when you look at the numbers, a large proportion of the market's gains over time tend to be concentrated in just a handful of days. In fact, if you go back to the late 1980s, it turns out that you would lose more than half of your return by missing out on about 24 of the best days. Exacerbating the problem even further is that most of those best days happen during bad times. They're either during bear markets or recessions or following very sharp market sell-offs, which is just when the market timer is most likely to be out of the market. Missing out on just those couple of days, being only 99% invested instead of 100% invested, cuts your long-term returns in half.
It's virtually impossible to figure out when those days are actually going to happen until they already happen.
Exactly, right? In hindsight, it's always obvious that, 2008 was obviously going to be a bad market because of all the things that went on. But you could have said the same thing in 2011. You showed a chart before of the VIX, and you saw some volatility in 2011 and 12. We had the European Union, fears of that breaking up, and the fiscal cliff in the United States. But it turned out not to be so bad. Even with the most recent presidential election, the common wisdom was that if Trump was elected, markets would fall. And they did fall for about 4 hours. Right? People that subscribed to the common wisdom and got out as soon as things started to decline would have missed out on a tremendous rally since then.
So it sounds like you've got to figure out what kind of portfolio you need. You need to stay invested. Maybe you want to sort of tilt it a little bit to small in value to get a little bit higher return, but maybe have a little bit more safety for a little bit smoother ride.
Yeah, and I think most of these things are things that you do ahead of time, right? Preparation instead of reaction. So you prepare by making sure that your portfolio, your mix of assets, is appropriate to what stage of life you're at and what your financial goals are. Right? And a lot of people forget that. They invest the way that they did 20 years ago, they never change, and all of a sudden they're closer to retirement and they have too much risk in their portfolio. And then you need to rebalance that portfolio to make sure that as one asset class does better than the other, right? We're in a great bull market for stocks. It's important for some people to rein in the percentage of stocks in their portfolio. And then finally, just remember that bear markets, corrections, and the like are part of the normal cycle of capitalism. They do occur, and people that are prepared for them and accept them and have proper portfolios generally wind up okay coming out the other side.
Thank you so much, Brian. That was great information.
Thank you.
And I think our viewers would agree. There's a lot of nuggets of knowledge there that you got to pay attention to. And we've got more information. We have an investing white paper at yourmoneyyourwealth.com. Take a look at that. But for now, we got to close out this segment, and we'll be right back after this break. You're watching Your Money, Your Wealth.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, Big Al Clopine hanging out, talking about volatility in the market. Want to thank Brian Perry, chartered financial analyst. He's a director of research at Pure Financial Advisors. Really great insight, Brian. We're going to continue on with the discussion. But before we do that, let's see how you did on the true-false question.
The longest bull market in the history of the stock market was after the Great Depression. You might think so, but that's actually false. As of August of 2018, the bull market we're in right now is now the longest bull market in the history of our stock market. Did you know that, Joe?
I did not. I do now. Alan, I do now. Thanks to Your Money, Your Wealth, I am that much smarter. I am that much. I mean, this is just really good information. It's used that, news that you should be using every day of your life. Now, on Monday, when you go to the office, hey, did you hear about the bull markets? But speaking of that, here's the problem. You got to control what you can't control. I think that is one of the biggest things, the gift that keeps on giving. We cannot control the stock market. We cannot control interest rates. We cannot control a lot of things, but there are a few things that we can control. Like number one, Al, is how we invest, I guess.
Yeah, I would call it the type of investor. And there's basically two types. I guess you can boil it down. There's the long-term investor. So that would be someone like Warren Buffett, those that pick a good portfolio. Maybe they rebalance as appropriate, but they kind of stick with it. And then there's the market timers. It's like, oh boy, market's too high. I'm in, I'm out, I'm in, I'm out. So you got to pick which kind of investor you are. Let me give you a hint. The data shows from decades of research that people that are long-term investors tend to do a little bit better.
But that's not saying if I'm a market timer, I can't do better, because there's a lot of market timers that do a phenomenal job. We're just getting everyone in the mix here today.
Yeah,
then you got to look at your allocation too, right? So, all right, well, we're looking at time frames. Am I a long-term investor? Should I time the markets? But then, all right, well, what's my allocation? How much money should I have in stocks and bonds? You can control this. This is your risk capacity or your risk tolerance. How much volatility do you want to have in your overall portfolio? But I think more importantly, Al, is that people need to understand how much volatility should they have in their overall portfolio to help them achieve their goals.
Well, that is correct, Joe. And you can control how much you're allocated in stocks and bonds. You cannot control the market itself, but you can control your exposure. Bonds are safer. If you need more safety in your portfolio, if your planning allows for more safety, then have more safety. We're big believers in having as much safety as you can in your portfolio to accomplish your goals.
You know, one of the things, too, that you want to look at is what you can control is fees and costs. You know, fees and costs is not the end-all, be-all, but if you're paying 3% versus 1%, or if you're paying 1% versus 50 basis points, I mean, over the long term, that could have a huge component on your overall portfolio performance. And then I think, finally, let's go to Big Al's favorite topic is taxes. This is where people really drop the ball. If you can figure out a way to save money in taxes, put more money back into your pocket versus Uncle Sam's, guess what? You can take less risk in the portfolio because less money is going out of the portfolio to pay Uncle Sam the taxes. You can control this if you do the right planning. And I think this is where, again, Al, people kind of fall short.
Well, I think so too, Joe. And really, if you think about it, if you've got money in a Roth IRA, you've got more control. So when you look at your retirement income, what your needs are, if you've got only money in your regular IRA, your regular 401k, and you pull money out, of course, it's fully taxable. Maybe you've got Social Security, maybe you have pension, fully taxable. Maybe you have money outside of retirement plans invested for dividends or interest income, fully taxable. So it's a matter of figuring out a better way. So first of all, getting money to a Roth IRA is important. So when you're in retirement, you start taking money out, that's tax-free. Then it's tax efficiently investing those assets that are outside of retirement to make sure you get capital gains, or maybe tax-free income like municipal bonds. Maybe you've got some real estate depreciation nets against it. It's really not what you make, it's what you keep.
Alan, you are correct, sir. You know, it's controlling the things that you can't control is probably one of the most important things of building an overall elaborate retirement investment strategy. Let's switch gears a little bit. Let's go to Alan's favorite component of the show, Ask the Experts.
Hey, Joe and Al, I've got a question for you. If inflation continues to rise, should I invest more in bonds or think about changing the way I invest my money?
That is a very good question, Alan. And so here's another thing. I mean, this is market timing, if you will. Is like you get these market indicators. It's like, oh, if inflation's going to continue to rise, should I completely abandon my overall strategy and do something different? Should I get into more bonds, or should I not buy stocks, or what should my portfolio look like? Guess what? Inflation is a part of life, right? You have to plan for that. And so as cost of goods and services increase, that's why we invest in the first place, to outpace inflation. So should you buy more bonds or should you buy more stocks? I'm not sure what that answer is without really understanding what your goals are. What is the demand for the portfolio? What is your tax situation? What is your capacity or tolerance for risk? That really helps set the stage. I don't think you change anything because inflation goes up and then it smooths out, goes down. I mean, that's just a part of life. So no, I would not abandon any strategy whatsoever just because we have a little peak of inflation. Next question, Alan.
While the market is high, my husband wants to cash in half of the investments in our retirement funds and invest that money in gold until the market levels out. Is that a good strategy? We're 2 years away from retiring. This is from Jill in Carmel Valley. Joe, I'll start with that question and to sort of piggyback on what you just said. Globally diversified investment portfolio should be designed to handle your goals and your needs in all kinds of markets. Market timing, although it's not impossible to make money, the probabilities are you'll do better just staying invested. It's very hard to time when the market is going to do a correction, and it's very hard, even if you get that right, to when to get back in. So I would not advise that even a couple of years away from retirement.
You know, this reminds me of 2008. I mean, the markets are up, and then all of a sudden it's like, here, let's cash out out and go to gold, the expected rate of return of gold is 0. Right? Gold doesn't grow on its own. So if you think financial Armageddon's coming down the pike, I would not suggest selling half your portfolio and go to gold. If you think financial Armageddon's coming down, don't buy gold, buy ammunition, right? Buy guns, because that will be a lot better for you than a gold nugget. Anyway, what did we learn today, folks? What did we learn? We got to get perspective, right? What is your goals? What are you trying to accomplish with the money that you have? And make sure you set up the appropriate portfolio for that. You have to invest in the long term. And what I mean by long term, and I know a lot of you are saying, well, Joe, I'm retiring in 5 years, or I'm already retired. I don't got that much time. Yes, you do. It's about the end of your life, which could be another 30 some odd years. And then just control what you can control. It has nothing to do with the markets, interest rate, inflation, gold, whatever. You can control certain things. You control fees. You can control your risk. You can control your emotions, and you control your tax bill. So that's it for us today. Hopefully you enjoyed the show. Want to thank again Brian Perry, our Director of Research at Pure Financial. That's Big Al Clopine. I'm Joe Anderson. You just watched another phenomenal episode of Your Money, Your Wealth. Have a great weekend, everyone.